Well, hello, everybody. This is Randy Wootton, CEO of Maxio, and your host of SaaS Expert Voices, the podcast that brings the SaaS experts to you to help us understand where we are today and what's happening tomorrow. It's my distinct pleasure to welcome a guest who I've known now for 11 years, Thomas Law, who is one of the co-founders and overseers of the Technology Services Industry Association. Has been there for the last 18 years, also a professor at Ohio State for about 10 years. We won't talk about the game, Thomas,
I appreciate
but
that.
started his career at SGI, still on graphics, and just has this fascinating story. And so, Thomas, I'd like to spend just a little time talking about your background. But for people on the podcast, just want to say you got to check out TSIA if you're in subscription businesses. It really is an incredible industry. The books, Thomas has written 7 books and has about 350 companies that are broadly involved with TSIA on their platform, but they have about 1,500 people that attend their conferences 2 times per year. I've been several times. Every time I've been, I've learned something. And so, Thomas, congratulations on all your success. The fact you've written 7 books, we were joking. I can't even get my first book out. So, well done on that. Can you give a little bit of background in terms of how your journey from SGI into TSIA, and then we'll talk a little bit about the state of the SaaS business models, what the impact is for specific B2B companies, and then a special metric you guys have developed, the rule of 35, not to be confused with the rule of 40.
Yep. Perfect. So my background, how I ended up the chair I'm sitting in now, I actually started back in the 90s at Silicon Graphics, right before the big .com boom there. And I started in IT, but then I got recruited to help start a consulting business. And so I spent about 5 years helping to build a consulting business embedded. And when I left SGI, one of the executives there said, "Look, you should write a book about what you just did because it's hard to build consulting within a product company, as you know." And I said, "Like, I never read a book before. I don't know how to get it published." And he said, "No, I've got connections. You should do it." So I did. I took time. I wrote a book. It got published. I started to interview to go back into an operational role, and suddenly my phone just started ringing when the book came out, and people said, "Hey, did you work at our company?" And I'm like, "No, why?" Because everything you're describing is exactly what we're dealing with here at our company on PS. So I started working on a second book, and when I was working on that, JB Wood, who's the CEO of TSIA, gave me a call, and he said, "Hey, man, I'm going to start this association model. I think it's going to be really interesting." And I'm like, "Yeah, I'm not so sure." And he goes, "Oh, let's give it a try." So we took a run up the hill, and I've been doing it, 18 years, and it's just been a great way to drive, data and insights for the industry. So I really enjoy what I'm doing.
Well, that's great. And then I remember coming to you in 2012, having been at Salesforce, which is clearly a subscription business model, and Mark Benioff and all that he did in terms of championing it as both a software as a distribution model through the cloud, but then also the monetization from CapEx to OpEx. And I remember my first conference with you all, I think you said something like 40% of the companies, broadly software companies, were cloud-based. 60% were still on-prem. And this was back in 2012.
Yeah.
Over the last 11 years, what have you seen? How has that transformation continued to unfold? And what's the current state in terms of on-prem versus cloud native?
Yeah, no, it's a great question. So you really, if you think about software companies right now, if we just focused on them, there's really 3 profiles right now. There are the born in the cloud companies like a Salesforce, and the key thing there is they've always been in the cloud, which means they're connected to all their customers, right? The customers are all on a common platform, and they have this recurring business model, right? Pricing model. The other extreme are software companies that are still basically, on-prem, disconnected from their customers, and they have still a traditional license and maintenance model. So there's still a few of those out there. That's definitely the minority percentage now. I would say that the biggest chunk is in the middle, and what you see is a lot of legacy software companies, whether you pick an Oracle, an SAP, whoever, it doesn't matter. And what they've done is they've moved their pricing models to recurring, right? So they have a lot of subscription revenue. So if you look at their 10Ks, you'll see these big growing subscription revenue streams. Underneath the covers, some of that is coming from true SaaS, but there's still a lot of on-prem out there that is simply in a recurring business model now. And so I put that on the table because there is a lot of the software industry that still has to eat through what we call this financial fish of moving from an on-prem model to a SaaS model, because I think there's no doubt that's the winning distribution model. I think you would agree. I mean, for customers, I mean, any software company that was started after 2006, I mean, they're not building on-prem software; they're building it in the cloud. So, but there's still a lot of migration that needs to occur underneath the covers.
Do you have a general sense from the people you talk to and the tracking of the industry as you do in terms of the split, in terms of percentage of software companies that are now born in the cloud versus on-prem, legacy on-prem versus hybrid?
Yeah, I don't know the exact percentage. I mean, there's still, there's a lot of software that is under, these big legacy companies that have been around for a while who
Yeah,
have big install bases. So that's probably still the biggest percentage is with these companies that are in that hybrid mode, right? They've got customers
right.
in on-prem, they've got customers in SaaS. I'd say they probably own the majority of the market still. Followed by the pure born in the cloud companies, and again, what that exact breakdown is, I'm not sure.
Yeah, I remember Steve Ballmer talking and having this debate about the private versus public cloud,
Yeah.
and that whole playing out of, are you going to have your own servers for some service that you're offering versus being in the cloud? And
Yeah.
clearly, it was his motivation was transparent for why he was
Right.
advocating for that.
Right.
But
Right.
then you have Satya come in,
Yeah.
who then goes all in on Azure.
Yep.
Just
In
such
the
what's a
public cloud
transformation
of
of the
thinking.
public cloud, right? Public cloud thinking, and he came out of the developer database division, and I left before he joined. Radical transformation, even in the
Yeah.
short time he's been there, around the
Yeah.
entire business model
Yeah.
of Microsoft.
Yeah. No, it is interesting in that debate in some ways still continues in terms of public versus private. Whether you're worried about security, whether you're worried about, intellectual property, whatever. And so that still goes on. What's interesting is, again, you think about this migration, you see a lot of traditional software companies when they start to first move customers to more of a cloud posture. It's often in a managed service type of offer where they say, look, we'll build a cloud just for you, an instance just for
Right,
you, and we'll manage it just that way.
right.
And they'll do that, right? So the customer's getting out of the business of owning infrastructure, they're getting the advantages of the cloud, but it's just for them. The only downside with that model is the economies aren't there the way they are.
Right.
I mean, the reason that the public cloud is so attractive is because of the economies. I mean, that's why it becomes such a dominant model.
Yeah. And so speaking of kind of public companies, one of the
Yeah.
things you guys do is you have your TSIA Cloud 40, which tracks the state of the software companies that are the cloud, the top 40 public markets. And you have a lot of different insights. We focus primarily on private companies, and our Maxio Institute Growth Report looks at 2,000 companies and talks about what's happening, and because we have the billing and invoicing data.
Yeah. Yeah.
And we were chatting in our pre-brief a little bit about what you saw happening in the broader Cloud 40, and wanted to give you a chance to talk about, well, what are you seeing? What's going
Yeah.
on
Yeah.
with growth and what's happening under the business model?
Yeah, and I'm sure the things we're seeing in the public data, and we benchmark a lot of privately held smaller SaaS companies as well, their operating models. And I have a feeling that, you and I are seeing the same things in our data sets, right? So 2022 was a watershed year for SaaS companies, as you know, because it just was this cold bucket of water. It
Yeah,
basically
yeah,
said growth at any cost is not okay
that's
anymore.
right.
And,
That's
and,
right.
and by
That's
by the
right.
way, the Wall Street Journal today had a large article in the business and finance section about the state of technology business models, and reiterating this point that tech companies are being way more cautious around their
Yeah,
spend and how they grow, and they're realizing they've got to do it more profitably. So that reality hit in 2022, and so if you move forward to what we're seeing now, this year we just took the Q3 snapshot. So we tracked 40 of the largest publicly traded cloud companies out there in this Cloud 40 index, and the good news is they're growing. On average, they're growing 14%, but I will tell you that's down from a couple of years ago when they were used to growing north of 20% on average, and some of them growing much faster. So there's been a slowdown in growth. The gross margins are improving because they are starting to really get serious about costs. On average, SaaS companies are doing about 70% gross margin. That's GAAP gross margin. Their sales and marketing expenses are getting chipped down. They used to be on average about 40% a year ago for these companies, down to 36%. That's not insignificant. So they're moving that. Those moves are helping improve their operating incomes. That's the good news. But on average, these companies are still, from a GAAP perspective, unprofitable. So it was about a negative 7%. across the board there. And even the largest SaaS companies in the world, like the Salesforces, they are profitable now. They've really focused on that, but their profitability profile is still about half of what you used to get in an old traditional software business model, right? So if a traditional enterprise software company could throw off, 20, 25 points of operating income, even these large, well-managed SaaS companies are still only throwing off around 8 to 10, if they're lucky, 12%. So it's a different model.
And is that because I remember at Salesforce, this was years ago, was there like, yeah, we're not profitable now, but at any point we could be because
Right.
we're going to stop spending on X
Yeah.
and we have this
Yeah.
recurring revenue and it's just going to continue to grow. So if we don't
Yeah.
spend, 80% of their revenue was booked because they
Right.
had
Right.
annual multi-year contracts.
Yeah. Yeah.
Is that still kind of the,
Well, no,
the
this is, I'm
pixie
so,
dust?
yeah. I am so glad that you said this, because I spent the last 8 years of my life arm wrestling with SaaS executives about this very point, right? So the logic has always been, because we've been ringing the bell about SaaS profitability for quite a while, because we've always believed at some point, sort of the music stops and you have to sit down on a chair that is a profitable business model, right? You just can't keep justifying, hey, don't worry about it. And so what has happened in 2022 proved it, is the message came out loud and clear. Hey, you have got to get more profitable to all these SaaS companies. And what they, and I was talking to these executives, what they painfully realized is, okay, I can start to work my cost structure, but I can't cut sales and marketing in half to become profitable, because where is my future growth coming from? Right. And so it was, it was a bit of a red herring, right? That this argument. And so what you're seeing is they're chipping on it. They're getting sales and marketing to go down, just like Salesforce. They didn't, cut things in half, but they, that was really, I think, a false narrative that has proven that, that it's just not what you can do. And it's going to take a lot more work for these companies to get into, a profitable posture.
Well, two thoughts on that. One is I just saw a recent article, literally, I think it came out yesterday or 2 days ago from TechCrunch
Yep.
that referred someone else and said there were 240,000 tech layoffs year to date, which is 50% more than all of 2022.
Uh,
50% more than all of 2022. So we
yeah.
still have another month to go. There can be more layoffs. And I do think the early companies, they lay off quickly. VCs are banging on them,
Yep.
extend their cash. And we're seeing big swaths of large companies doing it. To your point, Microsoft laying off 10,000 people is not a huge layoff as total absolute number of people being laid off it is, but they're doing this chipping, right?
Yeah.
Like where can they
Well,
trim?
yeah. Well, and I'm going to give you some numbers that are stunning, and I'm glad that you brought this up. So what a lot of SaaS companies did in 2022 to basically start to right the ship is they said, well, the easiest thing to go after is headcount, obviously. So
Right.
you start taking headcount out. But let me give you some numbers. So there's a website that tracks this on tech layoffs. During the dot-com bust, which you and I lived through, which I thought that was Armageddon when that happened.
Oh, amen.
Over a
Yeah.
two-year period, tech took out 300,000 jobs over 2 years. Okay, starting in 2022, and we're not even done with 2023, so not even a complete 2 years, tech has taken out almost 1 million jobs.
Holy smokes.
Yeah, it started in 2022, like, because the numbers you're talking about are just this year to date. You got to go back to 2022. So you put those two things next to each other, the dot-com bust
Yeah.
and this. Now the
Yeah.
talk track is, well, tech was bigger and we did a lot of
Yeah.
overhiring. Yeah, but 1 million jobs is 1 million jobs.
Right.
It's a
Yeah.
lot of headcount that came out.
And this is the third recession that you and I have been through. In
Yep.
2021, I was at a company, Avenue A, where one day we let go. We were 500 people. We let go 250 the next day. So
Yeah.
cut off 50%, but we're profitable the next
Yeah.
day. And it's
Yeah.
one of these lessons I've learned and held closely is the advantage of being profitable, right?
Yes.
You control
Right.
your own fate when you're profitable. And I think that leads to this next conversation around the rule of 40, and that there is a real difference between being 100% grower and 60% negative
Right.
EBITDA versus a 40%
Right.
grower and
Right.
profitable. Because if the 100% wobbles at all,
That's
you
right.
have this enormous cost structure
That's right.
that you've got to take care of. And if the market macroeconomic effects, you're screwed. And so, do you have any thoughts on that? I know we're going to get to the TSIA rule of 35 in a second, but just on the rule of 40 and how
Yeah.
you're seeing that playing out for
So
SaaS
what I think
companies.
is interesting about the rule of 40, and so and it's an important rule, right? It basically investors have used it as a way to hold it up to a company and say, look, are you, if you're growing 40% and you're break even, that's okay, right? Like you said, if you're growing 60% and you're losing 20 points on operating income, that's okay, right? Because that was sort of a bumper that was used. But the crazy thing about it, and when you look at these companies in the TSI Cloud 40, again, some of the largest cloud-based companies on the planet, there's very few of them that are rule of 40 companies, and that has been true
Yeah.
for several years. So it's
Yeah.
almost become a myth. And so companies will
Right.
say, well, I'm a rule of 40 company, and you look at it and you go, well, no, you're not. And then what they start doing is making up new definitions for the rule of 40. Well, I'm rule of 40 if you take this out and you add this and you
Right.
multiply this and you square this.
Right.
Look,
Right.
I'm a rule of 40
Right.
company. So I
Yeah.
think that to be honest with you, it has lost its value in the
Mm.
conversation, number one, because it's just become so confusing in some ways, so convoluted. And go back to the article in the Wall Street Journal today. It's not what investors are focused on. If you're growing
Hmm.
40%, or 50%, and you're losing 10 points, investors are concerned right now because
Hmm.
money's not free anymore. So
Right.
it's really hard to justify, right, that high growth and just say, well, don't worry about me losing money. It's okay. It's like, no, 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 no. It's not okay because that is expensive to fund that growth.
Yeah, to that point, as a private guy, a private company guy for most, I was public company for a little bit, but private company CEO, like my whole orientation in the age of free money was just about EBITDA.
Yeah,
But
absolutely.
then all of a sudden, you got to say, with high interest rates, you got to cover your interest nut.
That's right.
And, all of a sudden, you're thinking, oh my gosh, I have to generate EBITDA to cover debt. That's a
That's
really
right.
different way. Even before you're investing in the business, you
Yeah.
got to cover your debt. And I think
Yeah.
a lot of companies are taking debt. Equity is expensive. They took free debt and now they're paying the piper.
They are, and as I'm sure you're aware, maybe most of your listeners are, your particular audience, but the tax rules changed as well in terms of how much of that interest rate you can write off. So it got even more expensive. You had to pay this, and then there wasn't this huge tax write-off that you had, historically.
Yeah, no, great. So as we shift, there's the rule of 40, and then
Yep.
you guys, just to make things complicated,
That's
introduce
right.
this TSIA rule of 35, and it's
Right.
going to
Right.
take a minute for you to explain it. And
Sure.
as we talked about it, I was like, gosh, that is a really compelling way of looking at the business. So could you talk through,
Absolutely.
rule of 40, why you thought you needed to introduce a new
Yep.
rule of 35, and what are some of the insights you're seeing from that?
Yeah, absolutely. So the reason we put this rule of 35 on the table a couple of years ago is to start to get the lens around the operational efficiency side, right? Because again, the rule of
Right.
40 is rewarding growth, but the question is, okay, but are you growing cost effectively? So the rule of 35 is actually very, very simple. You just take your revenue, 100%. Here's my revenue. Subtract the percentage of your revenue you're spending on the COGS, right? So to get that gross margin,
Hmm.
if my gross margin's 70, that means I'm spending 30% on COGS, and subtract how much you're spending on sales and marketing, because those are the two big cost buckets, right? That are driving, your efficiency, your infrastructure
Yeah.
cost and then your sales and marketing. And you take those two out, you should have at least 35% of your revenue left, and you're covering G&A, R&D, and profitability. Okay. It is just a sort of a floor, right? Just a base to say, look, that's where you should get to start to feel that you have an operationally effective SaaS business. And the reason that rule is so powerful is every quarter, and I do this in my public webinars on the these indexes that we do, that anybody can attend, is we put the rule of 40 and the rule of 35 together, and we create this nice little 2x2. And in the upper right hand corner are technology companies that are both rule of 35 and rule of 40. And on the bottom left hand corner are companies that are neither. And what I can tell you over the last 2 years is the companies that are rule of 35 companies, their valuations are holding up much better than the companies that are in the bottom left. And the bottom left are all these SaaS companies that are no longer rule of 40 companies, and they're operationally inefficient, right? They're not rule of 35 companies. And that's the one that investors, they're just pummeling them.
Yeah. We were chatting a little bit. It was interesting. I've written an article on the two metrics that investors and operators can agree on, and it's one of them is very similar to what you described. I got it from Battery, and my general partner Chelsea Stoner beat this into me.
Yeah.
It was that you have two engines. You have a cash engine and you have a growth engine. And the cash engine, the way they calculate it, slightly different, but same idea,
Yeah.
is you take your gross margin, you actually subtract out G&A, R&D, and then you want to have what's left over is what you're willing to invest in growth. And that
Yeah.
growth could either go to sales and marketing, or it could go to a rainy day,
Right. Right.
or it could be your fund to,
Yep. Same
start building
concept.
cash for M&A. So
Yeah.
you have this cash engine, and their targets were 30% minimum, 50% best in class.
Yeah.
So
Yeah.
50 cents of every dollar after you covered COGS, G&A, and
Yeah.
R&D, you could put into growth. And then the
Yeah.
growth engine is another thing you got to get super clear about in terms of payoff and return. And so two different ways to look at it. I love your rule of 35 and the plotting that you're done. And at the end of the our podcast, we'll make sure people know how to get in touch with you and where to hear you talk about it, because it's super interesting to see that play out on the as you represent that and see it play out in the public markets. And I do think it provides this great seesaw between the EBITDA growth and operating leverage. Talking about the growth engine, though,
Yeah.
you have this really interesting metric that you guys use called RAC versus CAC. So
Yeah.
can you introduce that metric and what you've seen, why that's helpful, and why should people think about it?
Well, CAC is so interesting because it is so important, right? Our customer acquisition costs, what are we paying there to get a dollar of new revenue? It's been, a foundational metric in SaaS companies forever. But I can tell you, and you've been in the chair CEO, you look across a lot of companies struggle to really get their arms around that number. And so we've tried to benchmark it for years, and it's super noisy
Yeah,
data, super noisy.
right.
So what
Yeah.
we did is we created a proxy, and we basically just said, okay, here's the simple math. Take how much you're spending on sales and marketing. So let's say you're a SaaS company and you're spending 40% of your revenue on sales and marketing. And let's divide that by your annual growth rate. So let's say you're a SaaS company, you're growing 40%. So 40 divided by 40, that's your revenue acquisition cost. And in that case, the number would be 1. And the question is, okay, is that good, bad, or ugly? And we basically publish that number every quarter, again, from the public data. And I can tell you right now from Q3, the average rack number for cloud companies is actually 2.84. So they're spending 2.84% of revenue to get 1% of growth. And the really important thing is that there are SaaS companies that their rack number is much lower than that. Salesforce, it's 1.24, right? It's less than half. ServiceNow, 1.72. Zscaler, 0.46. So what does that tell you? If you're a SaaS company and you can do this very simple rack calculation, you can compare yourself to public companies, your competitors, et cetera. If your rack number is higher than your competitors, you have a problem. You have a serious problem because you are not as efficient at generating revenue growth, and that's going to catch up with you, right? I mean,
Yeah.
your ability to how much time and treasure you're going to have to spend to get market share, you are handicapped. And so it's again, I like it because you can use public data to look at it. And the other thing I'll also mention here is the rack numbers went down last year when people started whacking all their headcount and getting their costs, but they've been creeping back up. So SaaS companies are spending more and more, if you will, to get that next dollar. And I think, you probably talk to a lot of your customers. I know our members, they're feeling that sort of that headwinds of getting revenue. It's harder.
Yeah. So a couple of follow-up thoughts. One is under CAC. Yes, I agreed. I think being cloud native, SaaS native, it's one of these metrics you can hear about forever. You can use benchmarks out there. Ray Reich's benchmark study shows by size of company and your average ACV
Yeah.
what a good CAC is. The only thing with CAC is you can totally game it. You just go, grab a bunch of new customers, right? And it lowers your CAC for that quarter. And then and so you have to tie it in with churn and how much did you spend. The other thing I think the nuance that we talk about with CAC is like being able to assign costs to drive new logos versus current customers. And so how do you think about new revenue versus expansion revenue? And in a recession time, it's often easier to monetize your customer base. So how do you shift your marketing and sales?
And just to pause on that one. So we actually took a run up the hill several years ago. We published a paper around what we called CAC, KEC, and KERC. So what is that? CAC is your acquisition of your new customers. KEC, customer expansion costs. How much are you spending to expand existing customers. And then Kirk was CRC, customer retention costs. What do you spend on renewal dollars? And our argument was that CAC should be the highest, obviously, right? CAC should be a little bit lower, and Kirk should be the lowest. But you know
Yeah.
how many companies we found that actually did that analysis and understood those three buckets? It's the number's close to zero, right? So
Yeah.
it's just, again, but that's the right way to think about it. Exactly what you just said is really getting those dials right and saying, hey, I'm not just going to have this blunt instrument called CAC. I'm really going
Right.
to be looking at, how much it's costing me to expand and renew, because that's where the high margin dollars are for a SaaS company anyways,
Yeah, totally. Um, Not that you were intending it. There's a total tee up for the Maxio advertisement. Is if when you have a system of record that's tracking your billing and invoicing and doing your rev rec, you can absolutely get those metrics. And you press the button on day one, and you get the ARR. You get the MRR schedule, you get the ARR waterfall, you get all of this insight by product, by segment, by customer, by region. And you're able to do all your customer cohort analysis.
Yeah.
So it is really, part of the reason I came to this company was because my last company, we were trying to get those metrics through Excel, and Excel would bog down. Someone would change the formula, it would blow up. And we were on, a relatively small company. I can't even imagine what large companies do with, gigabytes of data, terabytes, whatever the biggest thing is of data, trying to make sense of it. It's just madness. And because there's no GAAP rules, it's all the wild, wild west. You kind of make it up on your own.
Yeah, exactly. Well, and I'm curious. You and I didn't talk about this before, but I'm curious what you're seeing is if you think about SaaS companies, you think about SaaS CFOs. I would say pre 2022, getting down to some of the nuanced metrics you're talking about was not a top of mind issue for a lot of these CFOs. It's not what they were focused on.
Yep.
And I was listening to this podcast. This guy had a product to help SaaS companies take out costs around, I forget what it was, and he said pre 2022 he talked to tons of CFOs, no interest whatsoever. 2022 hit, and suddenly his phone starts ringing off the hook. And I'm curious, for what you guys are doing for a living, are you seeing that same dynamic where it's suddenly like, oh, wait a minute, Randy, the metrics you're talking about, I did not really worry about that, but I have got to get my hands on those now?
Yeah, I think, yes. I think that what you're finding is it's this interesting ecosystem movement. The VCs have always been really interested in the metrics. So as a private company CEO, before I was at Maxio, we had to deliver templated Excel files to the analysts. And then they got wicked smart kids grinding the numbers and coming back to us and doing some of the math for us. The challenge was having a consistent definition, a regular representation. But I do think that they're smart VCs, and then even in the PE construct, perhaps more so, because the PE model is around EBITDA leverage. And so they are much more interested in what you were describing, in that tension between rule of 40, rule of 35, and then RAC and profitability. And so I think companies, private-backed, VC, PE-backed CEOs and CFOs are getting it. It's part of the reason we have 2,300 customers, right? Like it's a need. What I would suggest the challenge is old school CFOs, and I think that's my generation in particular, they want to do bottoms-up builds of models, and they want to be able to control all the information. And so they still feel most comfortable with Excel. It's like you can't pry Excel from their cold, dead hands. And I was talking to someone yesterday about this idea of the CFOs of the future need to shift from a spreadsheet model of data entry at the sale level to a database model where they need to think about data in terms of tables. And they have to be able to let go of data in the way that they thought about QAing it within a spreadsheet. And it's those CEOs that are now moving from compliance and governance and financial reporting to being strategic partners to CEOs, CROs in terms of monetization strategy. So I think there's a new breed. I think everyone's going to go there. And that's, what I tell people is, look, buy my technology or buy someone else's. Every B2B SaaS company needs to have a system of billing and invoicing that allows you to get these operating metrics so you can run your business. Also, you can manage your board. But one of our old adages was, get funded, stay funded. When you're going through due diligence, the number one issue that kills deals is accounting issues. And it comes down to ARR. Comes down to ARR. And so that then, your ARR, you're able to drive all of these insights. And so I think it starts with a common understanding of data, a system that allows you to make sense of it, and then a CFO who's is curious about that and wants to drive from the back office to the front
Yeah.
office.
Well, you put something on the table there, which is important. It's something you and I talked about before this podcast, is sort of the changing role of the CFO,
Yeah.
right?
Yeah. Yeah.
And do. I mean, you've seen it, more than I do. But when I spend time with these executive teams, they're all in the room, and I'm listening to the questions coming from the CFO, and they're, it's changing because to your point, they were kind of focused on the reporting and the governance and stuff, but they do need to be a partner with the CEO around what is our profitable economic engine for this company. What is that going to look like? And I will tell you, there are a lot of SaaS executive teams that have never, ever managed a profitable software business model, right? They've always been the high growth,
Right.
right? Not profitable,
Me.
right? And so now, right? And so think about that. You're a CFO, and suddenly people are, asking these questions about, well, tell me, like, how high is high for your operating income? What do you think that's going to look like 2 years from now, 3 years from now? And they're going, gosh, I've never really had to think through that, right?
Yeah.
And how I'm
Yeah.
going to get there. And so
Yeah.
I think that is really that there's a new muscle that's getting built there,
Yes.
and they really do need to be a strategic partner with the rest of the executive team to help get a vision around what the profitable business model is going to look like.
Yeah, and I do think again, as kind of a private, fast-growing, high-growth company, you can. Todd Gardner, another industry luminary, wrote this article. He calls it the porpoise principle, where you get profitable and then you can go unprofitable again, but you have demonstrated
You
the
could do it.
ability to control it.
Mm-hmm.
And it just forces you to make a bunch of, tighten up some controls here, do this, do that. And then it's almost like you come out and you look around and say, okay, now I'm going to invest here, but you're explicit about it. So you still could go unprofitable and you're taking down your cash or debt.
That's a great concept. I love that concept. And again, it's proving that you can have the discipline, and it's proving that that you're saying, look, I have a viable business model here. Here's what it is, and I can see it there. It's real. And you say, but hey, by the way, next year, whatever, we're going to make these investments. We're going after this new market. We're going after whatever, and you have a great story there. But you have street cred, where so many of these SaaS companies, they've never breached the water in your model there. They've never had the air.
Yeah.
Right?
Yeah. Just on that point. So I've been at Maxio for about a year and a half, and conversation with my board's great. But I come in with this VC mindset. I'm like, I want to do all these bets, and this is going to be a growth bet, and this is going to be a growth bet. And I got a little bit of an NPV analysis around it. And I'm like, yeah, this is the return we're going to see on it. And they're like, Randy, you're just like every other, venture-backed CEO. It's all about growth. And you at least have done an NPV, but we don't believe you. What you need to do is get the core business, make sure you've got that locked down and you can show it's a profitable business. And that's where I changed to embracing the old McKinsey model about Horizon 1, Horizon 2, Horizon 3, and just isolating the core business and saying, for this core business, this is the profile it needs to have. If we're going to go out and do M&A, or we're going to build in another capability, this is the profile it's going to look like for year 1, year 2, year 3. But we're going to be deliberate in terms of the gates we have. Is it working? Is it not? Will we fund more? Do we pull back? And what do we cut? And I do think that there's a portfolio approach that large companies do with that when they do acquisitions. They probably get a little lazy if they got a lot of cash, and they can say, oh, well, we'll give it an extra year or so. But I think in this new market reality, you got to get growth. You got to be deliberate about it. Is it going to be through organic growth, inorganic growth, segment expansion, regional expansion, capability expansion? Like that, as the CEO and the executive team, you got to be focused there. But to your point, the core has to be working to enable you to have growth conversations. If you don't have if the core is not working, you can't talk about the other things you want to go do.
Right. That's absolutely right. And I think that's a new reality for a lot of SaaS companies, to be honest with you. That they're now grappling with.
I made a note on this. We were talking about this in our pre-call about if SaaS companies, how to make them more profitable. What are the levers they can pull? You had a paper on it, and then I think you had a book, Digital Hesitation, which is around the new data-driven growth levers. Can you talk a little bit about those resources that people might be interested in pursuing?
In the papers out there, it's in the public domain. It's called the C-Suite Playbook for Profitable SaaS. And, sort of the executive summary. So there's 12 plays we outline there. But there's really 3 big thoughts I think every SaaS company should have to improve profitability. Number one is, you should be monetizing service motions. A lot of SaaS companies have given away their CS They've given away all their support. Their PS is break even, or they lose money. And again, that was okay when it was about growth, growth, growth. But I can tell you, we have all the data on it. There are SaaS companies that are very successful at monetizing their services. They're not giving it all away for free. That brings in real revenue to the business model, real margin dollars that helps the gross margin get higher, helps the bottom line. If the CFO says, hey, that's dilutive to my business, look, the math doesn't work out that way. So that's number
Yeah.
one. That's important. Number two, it's how you take the money off the table. So we call this migrating commercials. You should have a nuanced model. You can have renewal specialists and customer success managers owning renewals. You can have product-led growth. The product itself could be handling some of the commercials. And so not having every transaction go through the account executive is an important thought. And then the third thought, and Digital Hesitation, the book talked a lot about these growth levers. This world, and the beauty of SaaS business models is you are connected to the customer. You have data and telemetry on what they're doing. The question is, what are you doing with it to feed cost-effective growth? So, for example, we have a concept of customer-led growth. It means following the customer data to prioritize expansion, cross-sell, et cetera. And so salespeople every day they wake up, it's not like, well, who am I going to talk to? They should be following the data to find out who to prioritize. So that's just one example. And AI is just accelerating those new growth levers, for sure. But anyway, I recommend the paper. Again, this topic of how we get profitable. The good news is there are proven practices to get SaaS businesses profitable. I mean, I'm bullish. These businesses are not all going to be unprofitable in the long term. You can do it, but it takes building some new muscles.
This podcast couldn't come at a better time for people as they're building their fiscal year 24 operating plan and dealing with the reality of constrained capital, expensive debt, how to drive to profitability. We talked a lot about the different metrics you can use to set context for your journey, where you are today, what does world-class look like, where you need to go. And I think your playbook is a great recommendation for people to read as an executive team and just talk about it. I know, for example, monetizing services is one of the things we need to think about, which we've under indexed compared to what I was doing at Salesforce. I think the migrating the commercials and how to think about broadly the commercial relationship that you have with the customer and who does what, where, when is really interesting, especially in our business model. One of the things, just last point, and then we'll wrap this thing up, is price increase. So I saw an article somewhere that every single SaaS company now, because of the pressure on the revenue growth, they're not seeing the take up on new logos, that they're doing price increases. And I know Salesforce in August came out and said they're raising prices 9% across the board. And you're like, holy smokes. It used to be you would have kind of a 4 to 6% increase embedded in your contract. You went in with 6, you got negotiated down to 4, but 9% is mind-boggling. What are you seeing in terms of price increase, price levers broadly across the SaaS?
Yeah, it's funny. I was just talking to our CIO about this. What the because we have nothing. We're a SaaS shop, right? We have everything we're using is SaaS. And I said, so what are you seeing? And he is absolutely seeing people pushing across the table these double-digit increase asks. That is absolutely the thing that's happening. But I will tell you in my conversations with companies, about the state of this. So inflation over the past couple of years absolutely kind of gave us the ability to go to a customer and say, hey, things are more expensive. Everything's more expensive in my business model. And, and so if inflation's running 6% or whatever, I've got a bigger price increase this year. Right. And so I think customers were understood that logic. They were feeling it themselves, and they onboarded that.
Right.
I am suspect about these price increases this coming year because inflation is stable here, but customers are not going to just basically onboard double-digit price increases. They're not going to do it. So I think what we're going to see is that contracts are going to come across the table to the customer, and they're going to push it back, and there is going to be some intense. I mean, that's what we're going to do, right? We're going to be like, hey, that is just too big of an increase. And I think for a lot of these SaaS companies, I mean, if you are dominating in your marketplace and you feel super confident in your position, okay, you might be able to get away with it this year. But that's not a lot of SaaS companies, as you know. It's hyper competitive out there, hyper competitive in a lot of these marketplaces. So if you're coming to the table with a 10, 12% price increase, and somebody else comes in and say, hey, I can get you on my platform, and I'm not going to do that to you, that's going to happen. So I think it's going to be, I think it's going to be kind of ugly.
And I think that there's the must-have versus nice-have, vitamin versus
Yeah.
aspirin,
Yeah.
the Oracle play where they get you and then they just stick it to you, and you're
Yeah.
resentful for the rest
That's
of
right.
your contract with Oracle until you
Right.
can. I'm sorry for all the Oracle users; they provide a great product, but I think there's strategies they get you in, and then they hike the prices up because they
Yeah.
got you, and the
Yep.
stickiness is just incredible. But I
Yeah.
don't think that's true for lots of
Yeah.
SaaS companies. To your point, they can be replaced, and so
Yeah. Yeah.
as a CEO, CFO, thinking about what is your unique value, that it's not doesn't lock the customer in, but you continue to give value, so it's a value conversation versus a price increase conversation.
Yeah, absolutely.
Um,
You're spot on. I mean, and just to kind of to put a wrapper around this, I mean, if you think about making SaaS more profitable, the first lever is I take headcount out. Now, the second easiest lever is I do a price increase. And what I'm advocating for is there's this middle ground of your overall operating model that you've got to be changing, to your point,
yeah,
to deliver different value proposition more cost effectively. That's the hard work. That's the
yeah.
hard work. And I think that there's a lot of companies that have to lean into that.
Awesome. Well, that's a great way to end our conversation, Thomas. Every time I talk to you, I learn something. I really appreciate you making time for us. For other people that want to get the Thomas Law, free base, what is your best ways to track you down and to
Yeah, I would say
stay in
just go to
contact?
the TSIA website, www.tsia.com, and you can click into all the stuff we have in our webinars and our free content and learn about what we do for a living.
Yeah, and most of it's ungated, right? You have most of your content is
We
available
we
for
we have a
people to
lot gated
read.
for members in the different areas, but then we do have a good chunk out there in a freemium type model that people can take advantage of and learn a lot.
And then the most recent book that you published, I haven't read it. I'm still a big fan of
Yep.
B4B. I push it to everybody.
Yeah.
But what's your most recent book and the
Digital,
challenges you were taking
yeah,
on in that book?
digital hesitation, and that really is about having a more digital business model, which again has just become even more critical with the AI advancements that are occurring. So I think that's a good one. And the one before that, I think for your audience would be really good, is the as a service playbook, which is really about the plays you run to have a more profitable model.
Awesome, Thomas. I really appreciate it. Thank you very
Yeah,
much.
my
Have
pleasure.
a great day.
Yep.